Good morning and welcome to HLB's International Tax Webinar Series. Today, August 27th, 2019, we will be discussing the taxation of cryptocurrency. David, can you advance us to the next slide?
On the slide.
Great, thank you. Today, our presenters are David Cairns. David is a tax partner with Hawsons in the United Kingdom. Andrea Mouw is a partner with the National Tax and Accounting Methods Group at Eide Bailly. And Chris DeMayo is a partner at Withum Smith & Brown, where he leads the technology group as well as our cryptocurrency team. And I'm Kimberly Phelan. I am moderating the panel today. So David, let's start with you. Can you just give us a little bit of background about your exposure to cryptocurrency and your thinking around how it's used in today's world?
Well, the start of cryptocurrencies probably started going more live over the last couple of years as the price has been going up and down fairly dramatically. And we're now starting to see clients that are actively getting involved in buying and selling of it. So they're genuinely treating it as an investment, but not necessarily yet treating it as a transaction.
Okay, great. Andrea, how about you? I know you're on you're on your accounting methods. How are you seeing cryptocurrency being used?
I am seeing some of the same of what Dave is seeing. We are seeing clients look at this as a potential investment and a potential opportunity for them. We have some people who have set up businesses focused on organizing mining type activities. We've also even had a couple clients that have considered doing their normal day-to-day business transactions in cryptocurrency, accepting cryptocurrency from customers, using it to pay their employees, pay their bills, which has created some interesting tax consequences for them on the U.S. side.
Right. And Chris, how about you? I know you are maybe one of the few people that I know who own cryptocurrency. Can you tell us about your exposure and how you see the future of cryptocurrency being used?
Sure, Kimberly. I've been sort of fortunate enough to have observed the evolution of crypto for the last 7 or 8 years. And watching it from really its early days, its inception through today, and it's evolved a lot over the years. And some of the things that we're seeing now, we still see. There was sort of the initial coin offering craze that looked and smelled a lot like IPOs. We're seeing that still, and now we're seeing the growth of stablecoins, which is a whole new era of cryptocurrency. That's really interesting to kind of observe and watch as it grows out. So. Our clients are using these in a myriad of different ways, whether it's using them for investment purposes, using them transactionally, or using them to disrupt certain spaces in terms of a new way of transacting and from a contract perspective. So it's a pretty interesting time that we live in at this point.
Okay, great. If you could advance to the next slide, David, I thought we would start with how an individual is taxed. And you each have brought up different ways that you see cryptocurrency being used. People or businesses are investing it. Some are using it in their day-to-day transactions. And Andrea, you even talked about some people setting up businesses in mining cryptocurrency. Mm-hmm. So if you could maybe take us through how the United States taxes individuals when they are utilizing cryptocurrency.
Yeah. I can. The U.S. and the IRS's current position is that cryptocurrency is property. It is not necessarily currency in the same context as the euro or the U.S. dollar. It is taxed as property, and so the treatment of the tax consequences generally flow from what the nature of the individual's activities are. So in the case of mining, that would be an ordinary income type activity. Therefore, the fair market value of the cryptocurrency that is mined becomes income upon receipt and taxed at the 37% individual rate plus potentially self-employment taxes if the individuals are in a self-employed status as opposed to working for another firm. However, once the currency is collected, any future appreciation or depreciation in the value of that is taxed as capital gain, which has actually been an issue for our clients that were trying to use this to conduct day-to-day transactions. They were finding that if the cryptocurrency was worth $100,000 on the date they received it from a customer, but then when they turn around to pay their employees a month later, it had depreciated to $80,000, that $20,000 loss is a capital loss. it's not an ordinary loss. It doesn't offset that ordinary income that came in when they picked it up. So that's an issue that they've been struggling with and are considering revamping their business as a result. For those who are just using cryptocurrency as an investment mechanism, typically that's also going to be subject to the capital gains tax, typically 20%, and the gains and losses will offset each other. We'll have long-term and short-term depending on whether the holding period is greater than or less than 1 year. But we have seen some taxpayers that potentially could even qualify as a trader or a dealer. This analysis appears to be similar to what people typically use to distinguish between securities dealers and securities traders. If their activity is significant enough, the volume of transactions, the nature of the income, they could be classified as a dealer, in which case the income from those activities are likely to be considered ordinary income because the cryptocurrency is effectively treated as inventory. One open question that would solve some of the character issues we discussed earlier was if the traders would be eligible to make a 475 mark-to-market election, which we see a lot of our securities dealers and traders wanting to make. It's not clear right now that that election could apply to cryptocurrency, but if it did, I think that would be something that some individuals would be interested in.
Yeah, and this is Chris. Just to jump in and to further some of the interesting history that we have on the taxation. One of the things that we're dealing with right now is you have a lot of people over the course of time that kind of became day traders of cryptocurrency. So they were putting money into the system. They were flipping from one crypto to the other over and over again. Some of them playing an arbitrage between exchanges. And in the early days, a lot of people didn't know much about how cryptocurrency worked from a tax perspective. And in some cases, many people took the position that, trading of cryptocurrency only really became taxable at such time that you turned it into a fiat currency. In other words, brought it back into the traditional monetary system like US dollars. And as crypto evolved, what we came to find is that the IRS does view it as property, to Andrea's point, and in theory, then the act of trading from one crypto to the other could produce a taxable transaction at that moment in time, and that was something that I think has created a lot of stress amongst taxpayers over the years as taxation of this has evolved, and there's a lot of people that didn't treat their crypto trades in that way, which is why we're now looking at needing the need for more robust software to track the trading of crypto so that people can actually report their taxes accurately.
I think we might have lost Kimberly at this point in time, so I just progress on to the next slide, which is the UK taxation. The UK taxation is predominantly going to follow the American basis. So the UK tax authorities came out in December last year and just advised that there is no new legislation in place. This is just how the taxation of crypto assets and cryptocurrency is dealt with all the time. So for mining, as we've mentioned before, even if you're an accidental miner getting a crypto asset in your portfolio, you'll be subject to the UK income tax rates at up to 45%. If you are really heavily involved in trading in the activity of mining, then that can push you into normal trading activities rather than actually just ordinary income tax. You can get subject to the Social Security taxes as well. But like the American system, future growth is normally going to be within capital gains tax. For most people involved in buying and selling crypto assets, this can be treated as an investment. So it's capital gains tax rates. The UK capital gains tax rates is typically up to 20%, and losses can be used against other gains arising in the same period or in future years. Certainly, on the trading aspect, HMRC does consider that trading in crypto assets is a bit like trading in shares. Historically, they've resisted it immensely because most people have been getting losses on trading in shares, as they have with Bitcoins, and they're very reluctant to allow people to have those losses to offset against other income and gains. But it follows all the usual badges of trade that if you are genuinely doing it to generate a profit, then it's going to be subject to income tax as normal.
Great. Thank you for that. Maybe we can move on to, and the first question is, as we've talked, there are differences between individual tax, whether it's investment or whether it's property, and it might end up as a capital gain. So if we could talk about how do you identify those capital gains, both from the U.S. and the UK perspective. And if anybody online is participating and has a difference in their country, we'd be happy to hear that on the chat box and have that come forward. So Andrea, you want to start with identifying capital gains in cryptocurrency?
Yeah, and unfortunately, as we'll talk about a little bit later, the guidance we've received from the IRS to date was issued in 2014 and was not terribly robust in terms of topics that it addressed. So it did not specifically address how taxpayers are to identify the lots of cryptocurrency. It would appear that they could rely on the existing methods that are used for stock and other investment sales, looking at specifically identifying the units that are being sold either on a FIFO or some other basis. But the key is, as with other areas where this issue comes up, is going to be consistency. Whatever the taxpayer chooses to do, they should stick with it. If they're going to go FIFO, they should continue to use FIFO and not change back and forth among methods going forward to try to achieve any particular tax result that they're after for that year. But yeah, unfortunately, this isn't an area where we have received anything distinct from the IRS.
Okay,
yeah,
so we're just following the normal identification rules. Go ahead, Chris.
Yeah, and I think from a functional perspective, for years people were kind of left to deal with spreadsheets and self-reconciliation, and that's a very, very difficult thing in the world of crypto, especially when most people trade on multiple exchanges. So while you'll know that Coinbase is one of the most popular exchanges. Some people use Coinbase and Gemini. Some people trade amongst them a broad spectrum of exchanges. So this act of reconciliation can become a real challenge for an individual that's trying to genuinely report their gains. As a result, the market is signaling a need, and now we're seeing softwares that are coming out that are addressing this issue directly. So what's kind of exciting is we're getting a lot of options out there for softwares that will allow you to plug your public key into their software, and it will do a full reconciliation, and it will allow you to do FIFO, LIFO, or average cost. It will allow you to toggle between, and it will reconcile all of your transactions amongst all wallets. So we expect to see, at least from a functional perspective, better ability to put reporting together. Prior to 2017, 2018, when crypto really popped and went into the public lexicon, there was virtually no options there. So from a practitioner's perspective, we were really left with the unsavory position of kind of taking whatever information we get and throwing it onto a return because we don't have any better information available. And I think that gap is closing rapidly right now, which is a great answer for us as practitioners.
Yeah, certainly the currency exchanges are starting to able to provide information really on a monthly basis or an annual basis. But as I say, just the question there whether it's income or capital gains. The UK, as I say, is desperately trying to treat cryptocurrency as capital gains or investment. So it doesn't have to give trading losses. So it's only when the activity really increases and we follow badges of trade that we start getting into the trading position, apart from mining up front.
Great. Anything else you want to add on identifying capital gains, David? Some of the rules, the rules.
Yeah, well, as I say, with the capital gains tax rules for the United Kingdom in terms of identification, the UK HMRC has brought in the same form of share rules. So what we'd do is we look at same-day transactions and we match the profits or losses on those. We then look at profits or losses occurring in with 30 days. So this is the bread and breakfast type rule. And then once we're outside of those transactions for individuals, then effectively we just put it into one pool of average cost and numbers, which we call the Section 104 pool. As you add things in, so you increase the numbers and the cost. As you take things out, so you decrease the numbers and the cost, to give you your capital gains position.
Great. If you could advance to the next slide, David. We've talked a lot about how individuals might use and then therefore be taxed on cryptocurrency. How is this different for companies? How is a company taxed? Let's start in the United Kingdom this time. So David, if you want to continue on talking about how businesses deal with cryptocurrency transactions.
Okay. Well, as far as the United Kingdom is concerned at the moment, there is no formal guidance from HMRC in terms of how you should deal with it. So there is nothing in the revenue manuals, there's no printed guidance, and the only thing I've been told so far is it's going to be followed up at a later date with more interpretation and guidance. But it probably comes down to accounting in the end, in the fact that it depends how the company treats it in its records. Is it treated as an inventory or a trading item, which is for held or for sale in the ordinary course of business, or is it going to be held as a longer term investment or an intangible asset? So it could be trading income or it could be capital gains, but the one thing with corporate tax is they're actually at the same rate of 19% currently. So there's going to be no difference in the rate of tax that they actually pay. But again, we're just waiting for the formal guidance or law to determine how it's going to be treated.
Okay. Andrea and Chris, how about from a U.S. perspective?
From a U.S. perspective, in a C Corp setting, we're going to end up in a similar position to the U.K. in that there's a flat tax rate, 21% that applies regardless of the character's ordinary or capital. So it does take some pressure off that distinction as to whether the asset is ordinary or capital in the hands of the investor. In the case of a pass-through entity, a partnership, or an S corporation, that income will be taxed at the individual level, consistent with our prior discussion. So we're going to be looking at, in that context, the nature of the activities of the S Corp or the partnership to determine whether the character that flows through to the partners and shareholders is going to be ordinary or capital.
Great. Okay, we're almost through we have two more questions to discuss on the actual taxation of cryptocurrency. The first is on the next slide, David. How is an employee taxed on the receipt? In this example, we've talked about mining. So maybe, Chris, to kick this off, can you talk about how mining gives an individual compensation through cryptocurrency? And then, Andrea, jump in with how the U.S. would tax that, and then we'll move over to the U.K.
Sure. So when you think about mining, in many distributed ledgers, blockchains, the way that blockchains are constructed is that these independent third parties that we call miners are working together to solve math problems to ensure that transactions that are happening on the blockchain are accurate, are correct, that the person that's giving consideration in the form of cryptocurrency actually has that cryptocurrency to give, and that it's correctly going to the right wallet, and they're building blocks off onto the distributed ledger. So when you think about mining, it could be an individual, it could be a company, it could be any form of entity that is putting their time, literal energy, and hardware to work in order to solve these math problems. And they're being compensated in the form of brand new, newly minted cryptocurrency. So the prevailing thought at this point in time is that the receipt of that cryptocurrency in exchange for these perceived services would be compensatory to them at fair market value at the time that that cryptocurrency is issued to them. I don't know if Andrea has any additional thought process there.
No, that's consistent with the way we've been thinking about those transactions also. And I don't know if you've ever dealt with any scenarios where there is a potential right of forfeiture, such that, you know, an 83, a Section 83 or 83B election might come into play. We had one client who was compensating their employees using cryptocurrency, but it was tied to a continuing employment obligation with the entity. And so I know we had looked at the ability to file an 83 election, and right now I don't know that there's a clear answer on that, but I'd be interested to hear if you've heard or seen anything like that.
Yeah, you know, we've had certain scenarios where compensation had been restricted, and I agree with you. At this point in time, the guidance is pretty ambiguous as to whether or not 83B would apply in these scenarios. And I think one of the problems that we have is, you know, every day our clients and the marketplace are finding more and more unique ways to compensate people through cryptocurrency. You know, for example, things like airdrops. You know, where do these things fall in the lexicon of taxation, and how do they fall into our current and existing regulations? And you know, I think one of the challenges that we have is a lot of this is, you know, regulation around this, even getting outside of the IRS and just getting into general regulation. You know, cryptocurrency has been really a hot potato within the U.S. Regulatory authorities, and nobody seems to want to own it and take a position on a lot of these areas. So they allow the marketplace to try to create trends, which is leaving us in a really tough spot.
Wow. Okay, so a lot of issues still to be resolved with this. David, what's the situation in the United Kingdom?
Okay, well, with the United Kingdom, I mean, so the first question you ask, is the guy an employee, and is he receiving effectively payment in Bitcoin? If he is, the UK will treat that as what's termed a readily convertible asset, so it's money's worth, so something that pretends to be money, even though HMRC don't agree with that, but it's easily convertible into pound sterling. And when you get that sort of payment to an employee, it's just subject to all the usual employment taxes and PAYE. Picking on the other things that's mentioned before, if it's outside of employment, then we're back into the mining question. So somebody who makes miscellaneous income, but it's still subject to income tax. The trader is also subject to income tax, the professional miner, but he again adds on national insurance. And I think I heard the word airdrop there. If you bring in an airdrop by itself, as somebody who is not an employee and is not trading, he will just get the airdrop for nothing. But essentially, when he sells it later on, he will pay capital gains tax but have no base cost. So there's lots and lots of conundrums, but as I say, when you tend to get them through employment or mining income tax, otherwise it might be capital gains tax later on.
Okay, if you could go to the next slide, we have our last truly tax-based question regarding crypto assets. Talking about the value-added tax and the sales tax. So this, I think, is the easiest question of the lot. So Chris and Andrea, what does it look like from the United States perspective?
Oh, you know, we don't have a national VAT or sales tax currently, at least, and so those are generally in the jurisdiction of the states or local municipalities. And the states that I have encountered with our clients have not been overly aggressive, and I don't believe they've taken any action to tax these transactions. But I don't know, Chris, have you seen anything?
No, I mean, I haven't seen any states taking action to tax crypto transactions, and we're really not seeing even a lot of, you know, prevailing legislation out there that looks like they're going to get aggressive around taxation of the transactions. I think when you look at cryptocurrency, one of the things that I think a lot of states are concluding is, you know, in the end, it is a chameleon, right? And what I mean by that is it can be a currency, it can be an investment, it can be, you know, a form of payment. There's so many different forms that cryptocurrency can take. There's really no way, in my mind, pragmatically, that a state could place a blanket tax on it. So whether or not it's subject to sales tax, I think really will always be based on the underlying nature of the transaction itself on a case-by-case basis. So if you're buying a car using cryptocurrency, that transaction will be subject to sales tax. But for the most part, of the 50 states, I think 49 of them are not accepting cryptocurrency as a form of payment, with the exception of Ohio. So we're still living in a world where fiat currency is going to be the currency of choice in terms of actual compliance with these regulations.
Great. David, how about the VAT in the UK?
Well, currently the UK doesn't recognise Bitcoin or crypto assets as being subject to VAT, and I think that's probably much European-wide. As Chris sort of mentioned, where you've got a transaction, you would apply your VAT and your sales tax as that normal transaction. But if you just simply settle that transaction in Bitcoin, even though we're not supposed to recognise it as currency, it is still settlement of that trade. So the overall trade or activity is subject to VAT, but Bitcoin is not. It's outside the scope currently. I use the words outside the scope. People also use the words as currently exempt. So currency is outside the scope, but financial products are exempt. So it's perhaps not something we have to worry about in the near future. Excellent.
Okay, if we could go to the next slide now. As we've talked about cryptocurrency, one of the keys here is, what is the situs of a crypto asset? Where, because you have to have situs to determine taxation. So how do you determine that? Andrea and Chris?
Yeah, on the U.S. front, not to sound like a broken record, this is another one of those issues that the IRS has not yet addressed in any guidance. And so what we're usually left with in that scenario is looking to how other similar transactions are cited. So, for example, what are the current rules for situs for inventory transactions or capital assets or provision of services, and trying to say, okay, is mining the provision of services? If so, then we will situs it following those rules, which is generally where the service is performed. It's left a bit of a gap in that guidance. And then the other question that has come up, as far as activity within the U.S. is, for foreign investors, typically they can avoid being subject to tax on the U.S. connected income, other than for withholding on dividends and interest, if they're merely trading in securities, which then raises the question as to whether cryptocurrencies are securities that could qualify for that safe harbor, or whether foreign individuals dealing in cryptocurrency with exchanges with individuals within the United States, does that generate a tax filing obligation? And I don't know that we have a clear answer to that right now.
Yeah, and taking a step back, when we think about how to account for cryptocurrencies, and we're looking at a variety of different regulatory bodies to help us with that. What the only regulatory authority that's come out and given any kind of guidance is the SEC. And for the most part, the guidance right now is, again, under the guides that cryptocurrency is sort of like a chameleon. The way that you determine how to account for it is you have to first figure out what it is not. So based on the nature of the transactions, is it a security available for sale? If not, is it inventory? If not, is it cash? And you go down the list of what it is not until, if you've ruled everything out, you ultimately end up concluding that it is an intangible asset that has to be accounted for at cost. And that can help drive, when you think about the accounting, it can also help drive how we think about the situs. But yet there's limited guidance on this. So again, we're out there doing our best to come up with what is the most pragmatic solutions.
Great. Now, David, there's a special issue with the United Kingdom because you have different levels of residency. So do you want to talk about the situs of crypto assets and how it impacts residents that are not domiciled in the UK, but resident there?
Yeah, sure. So one of the problems you have with crypto assets and the blockchain, of course, it's actually located everywhere. And unless you actually go and find the servers or servers where it's located, then it's very difficult to determine where it is or how you deal with it. But the one thing the UK does, so if we've got UK resident individuals who are non-UK domiciled with overseas investments, subject to some certain rules. They only get taxed in the UK if they remit those income and gains to the UK. So if you've got non-UK situs assets, potentially people don't, or resident but non-UK domiciled individuals don't have to pay capital gains tax or income tax. For inheritance tax, that tax on death, then effectively it's only UK situs assets which are relevant to non-UK, non-resident individuals. So for years, I will describe people as foreigners, but the rest of the world who own houses in the UK have put them through company and trust structures, so they're no longer UK situs assets. So this is a real conundrum, and as I say, it's one which HMRC just don't know how to interpret at the moment. So it's something that's coming in terms of regulation in law to give us some guidance about how to deal with it.
Great, and then that takes us to the next slide, which is really how are crypto assets regulated or unregulated in their use? Do you want to continue on, David, and talk about how the UK looks at regulation of crypto assets?
Yeah, I mean, so the UK is absolutely very supportive for crypto assets. It's the next generation of technology, it's electronic and all the things which are good. But the problem in the UK at the moment is it's currently very much unregulated. And whilst it's unregulated, people may not have the confidence in it that you would with a regulated currency. So again, the UK wants to support it, and we do actually have some reports by the Crypto Assets Task Force, but they want to work out how you can make it work in the market, how it should be regulated, and then probably introduce something which they'll be suggested as the early part of 2020. But one of the other problems with the crypto assets, of course, is that not all the countries around the world accept them, and some have even made them illegal as well. So I'm just looking at one particular document, which is actually off Wikipedia, but there's 43 pages down there of how each particular country and territory currently recognizes crypto assets, and it's a total mishmash.
Okay, and Andrea and Chris, how about in the U.S.? How have different regulatory bodies approached crypto assets?
Yeah, as I mentioned before, when we look at the U.S., we tend to first look at the SEC to see how they're approaching crypto assets. And in the early days, the SEC had a very tepid response to cryptocurrency in general, and then became actually kind of aggressive in going after companies that they felt were trying to either manipulate the market or take advantage of what was a frothy crypto market early on in 2017. But we have seen some warming up in the SEC, which has been good. In fact, recently in the last 2 months, there were 2 initial coin offerings, which are, for those who may not be familiar, they're similar to very small IPOs where there's or insider offerings where there are offerings of cryptocurrency to specific types of investors. And the SEC, worked very closely with those entities and ultimately approved those offerings. So we are seeing paths forward in terms of regulatory authorities warming up to cryptocurrency here in the United States. I think we have a ways to go, but I think it's going to be good for markets. There are a lot of cryptocurrency purists that believe that regulation is a terrible thing. But my personal opinion would be that regulation in any industry is something that we should welcome because it creates public trust and then a broader net of people that would participate once public trust is established. As David had mentioned, I think trust in the marketplace is actually holding the proliferation of cryptocurrency back a bit.
Yeah, and I agree with your comment earlier that it's a hot potato. I think that's an excellent description of this. Nobody really wants to be the first one to move too far too fast. Everybody's still trying to figure out what this is, how this is going to fit into the economy moving forward, and then which group should take lead on regulating it. So it will be interesting to see over the next few years how all this unfolds.
And that kind of leads into the next question on the next slide, David, which is, what are the red herrings or the incorrect stories that are out there regarding cryptocurrency? Andrea and Chris?
I think the fact that the word cryptocurrency includes the word currency, I think makes a lot of people think, oh, I'll account for this using the same rules I'm using for my euros and my Canadian dollars, and that's not at all the case. The IRS effectively turned this into by calling this property, this sort of applies a barter type analysis to the transactions in cryptocurrency. And for a long time, I think people believed that no one was tracking what they were doing in currency, in the cryptocurrency, in the trading and selling of that. So they didn't believe there was anything to report to the IRS because nobody else was tracking it. They had no obligation to report the income. And they were also looking at this, on a de minimis. They're hoping that there was some sort of a de minimis standard. Like if I use Bitcoin to buy a coffee at Starbucks, I don't have to report that transaction. Well, given the way the IRS has classified these transactions right now, there does not appear to be any de minimis rule. And so if a taxpayer was looking to engage in daily transactions in Bitcoin or any form of cryptocurrency, the record keeping burden is extremely significant.
Yeah, and I think that to dovetail off of those points, which are really right on point. I think the IRS's point of view on cryptocurrencies is an area where people are paying attention and it's evolving. So the Internal Revenue Services started working with exchanges to try to obtain trading activity, and they were able to successfully do that with some fairly sizable exchanges. And as a result, they are now exploring, taking action and taking next steps on potential abuses of cryptocurrency trading. And that's creating a lot of narrative in the marketplace about what that means in the crypto world. Is the IRS going to get very aggressive with traders? Are they going to look to make examples of people that maybe didn't report transactions when they should have? So where that goes, I think is going to be really interesting for us as, the IRS has started their outreach amongst heavy traders where they obtained historical trading data, and what are they going to do with that data? Are they going to make examples of people? What's that narrative going to be? I think that's an important thing that we're going to see roll out in the next 6 to 12 months.
Okay, David, how about from the UK perspective? What are the red herrings and the incorrect stories out there?
Well, I think they pretty much follow the US situation as well, is that once you actually take these things as not being currency into assets, then it's an entirely different story. So people will say that investing in Bitcoin is a gamble. Well, clearly it might be, but so is the stock market. But it's not a taxable event. HMRC don't accept it. You are got an investment, you're trying to make money out of it. It's not currency. Perhaps one thing that might be a bit of a scare, which people aren't aware of, that is as you exchange one cryptocurrency for another, you've got two transactions there. You've got a disposal and acquisition. And I think HMRC have even muted that moving from one exchange to another is a disposal of all your assets under one exchange and the reacquisition under another. So there's plenty of things there which could come out and bite you, and HMRC are looking to tax them.
Okay, so be careful out there. Now, we're going to talk about two relatively new issues regarding cryptocurrency and then get into the guidance that we've seen. So the first is, what is a hard fork and what is the proper tax treatment thereof? And I'll put it out to the three of you to discuss this. What is a hard fork and how do we tax it?
Well, in general, a hard fork is from a technical perspective, is a divergence in the blockchain of the cryptocurrency that results in formation of an entirely new parallel version of the cryptocurrency. And the best example, or probably most common example, was in 2017 when Bitcoin went through a hard fork and created Bitcoin Cash. All of the owners of Bitcoin on the date of the transaction received an equivalent number of Bitcoin Cash units on that date, and moving forward, those are now on different different blockchains to track them going forward. And I don't know, Chris, do you have any better explanation of that? I'm not a very technology savvy individual, I will admit.
Yeah, I mean that's effectively correct. I mean, what happens is as blockchains continue to evolve and grow, there are entities that, I guess, for lack of a better term, oversee or shepherd those blockchains forward, and the technology that underlies Bitcoin, the blockchain technology, also evolves and changes. And there are times when groups of individuals that oversee the blockchains may disagree on what direction that technology should go, and that can create a fork. Also, forks can be created if there's some type of a technological glitch in a blockchain. And effectively, what a fork is exactly how you described it, Andrea. It's the duplication of a blockchain that already existed, but those two blockchains now go off in different directions. So basically, these cryptocurrencies are mirrored at that moment in time. And if you had one Bitcoin, you now have one Bitcoin and one Bitcoin Cash.
And the tax issues from these transactions obviously were not even contemplated probably by the IRS in 2014, the last time they actually gave us much guidance. And so the questions that arise here are many, actually. I mean, first of all, is that a realization event? Is that a taxable transaction when I receive Bitcoin Cash as a result of my ownership of Bitcoin on the date that this hard fork occurred? The general tax principles would certainly seem to suggest, yes, you have received something of value, and the definition of gross income is broad enough that it would seem to encompass that. But then you're left, okay, well, what's the value of this stuff? It didn't exist literally the day before I received it. How do I figure out what the value was on the date of issuance? And then what happens to my basis in this? I had basis in my original Bitcoin. Do I leave that basis in the Bitcoin and just pick up basis if I recognize income on the Bitcoin Cash? Do I allocate some of my Bitcoin basis to the Bitcoin Cash? How does that work? And then what about my holding period? Does it relate back to the date? If I'm holding this as an investment, I'm going to be looking at the short-term, long-term capital gains line very closely, and then the question becomes, does my Bitcoin Cash holding period begin on August 1st, or can I look back to the date that I actually bought my Bitcoin for my holding period? And this is probably, of the comment letters that have been submitted by AICPA, the American Bar Association, other entities over the last, in the last probably 12 to 18 months, this has been a very significant issue that they've been pointing to of, we've got a lot of clients, a lot of taxpayers that have undergone these transactions with potentially material consequences, and we don't know what to do. So that's one of the areas that they've probably been pushing the IRS the hardest on, is trying to figure out how to account for these transactions.
Yeah, certainly from the UK view, I mean, so both these concepts of hard fork and airdrops and additional things coming through, there is a couple of sentences in there, but it's not actually very decisive about how you treat it. It just seems to be on the basis, if you treat it as an individual, you are getting something for nothing until such time as you realise cash or value from it when you deal with capital gains. If you are trading and you receive these things, then you might be subject to income tax, but it is just very uncertain about which way they're driving you down to find an answer.
And the airdrops are interesting also because that currency is also usually not previously in existence and may not even turn out to be widely accepted in the long term. So it could turn out that there really is, you get something, but the value of it on that date is virtually zero.
Yeah.
When you think of airdrops, I think of them as a bag of magic beans, right? I mean, those are cryptocurrencies that people are trying to promote, and they're literally sprinkling them amongst the public to try to create some level of enthusiasm for them. You're 100% right. I mean, they could be worth a tremendous amount of money. They could be worth absolutely nothing, and I don't think anybody knows what they're worth on the day that they receive them.
This could almost be an extension of mining, but I don't think anybody's actually made that link yet, when you get something for nothing or after something with a small amount of effort involved.
Oh, so we're adding new words to the lexicon of crypto assets every day. On to the next slide, David. What are stable coins and how do they work? Chris, do you want to start tackling this one?
Sure. Stable coins are a really interesting new evolution in cryptocurrency. So I tend to say what is old is new again. That's how I describe stable coins. And what a stable coin is it is a cryptocurrency that is backed by either a fiat currency or a mineral, such as gold. So just as the U.S. banking system was backed up by gold all the way up to the 60s, now stable coins are backed by a fiat. So as an example, a typical stable coin is backed by a U.S. dollar. So you can buy a coin and you submit your cash in exchange for that coin, and there is a one-to-one conversion into U.S. dollars at any point in time. So if I went to an exchange and I bought 10,000 stablecoin, I would spend $10,000. I'd receive 10,000 stablecoin, and they will always convert back to a one-to-one conversion ratio. So what's the purpose of this? Well, if you can get a wide net of people using stablecoins, it allows people to transact in a fiat currency that they trust very, very quickly and without the general, restrictions or regulation that you might normally come across. So if you want to transact in US dollars between a US entity and an entity in certain regions in Asia, that may take time, that may be difficult, it may be impossible in certain regions, but using a stable coin, you can do it instantaneously. The idea is that the exchange that is hosting that stable coin keeps a reserve of, we'll call it US dollars in this case, that is always going to be sufficient to satisfy 100% of the stable coins that are in circulation. So in theory, if there's 1 million stable coin in circulation, there would be 1 million US dollars at any given point in time to satisfy that demand. So this is something that has really grown out a lot in the last 12 to 18 months. There are new stable coins being created every day. They're typically built off of the Ethereum network, so it's usually an ERC20 token that's being used, although some are not. So the way I liken this, why would a company create a stable coin? Often what we're seeing is that the major exchanges are doing it because it's a very nice add-on to their suite of services and offerings. I kind of liken it to free checking, right? It's just another offering that an exchange can give to the marketplace to try to attract more people to use their exchange. At the same time, a lot of these stable coins, are likely making money off of the interest associated with the dollars that are sitting in their accounts. So that's another economic benefit. But we're seeing this as a really big area of growth in the stablecoin in the cryptocurrency network. In creating better ways for people to transact faster and more cheaply.
Great. Okay, we're coming down to the final topic, which is talking about guidance and how the tax authorities are responding. So, David, can you quickly on the next slide take us through what the HMRC has issued in terms of guidance?
Yeah, the UK had a long think about it and actually issued some very comprehensive guidance on the 19th of December last year. And they actually are very proud to believe it's one of the most comprehensive sets of guidance actually issued by any government around. But it's based on their interpretation of how the law applies to cryptocurrency, not necessarily specific regulation and law which has been released to deal with the taxation of crypto assets and currency. But it is now starting to appear in their guidance notes, and I saw an update only as recently as the 21st of July. So HMRC are now wanting to tax it and issue guidance about how it's done. It probably needs legislation to make it work properly.
Okay, and Andrea and Chris, on the next slide, we see that in 2014, the IRS issued some guidance. Any update on any new guidance forthcoming, you think?
I believe that there was an individual from the IRS who's quoted a few months ago indicating that a revision or expansion of this guidance was in the works and potentially nearly imminent. i.e. within the next several months. However, given the tax reform legislation that passed a little over a year and a half ago, IRS and Treasury have been buried in trying to implement that. So unfortunately, I think that has probably pulled their resources away from this to some degree, but my understanding is that they do have something that is quite far along, which will hopefully be broader than the original notice and perhaps more comprehensive, as was the UK guidance, that will help address a lot of these issues that have arisen since 2014.
Great, so we can look forward to that. Now, in the meantime, however, on the next slide, is HMRC or the IRS, are they being offensive, and how are they seeking out non-disclosure of gains? And this is the issue that's really most recently in the news. So from the US, do you want to discuss, Andrea and Chris, the action letters that have been sent by the IRS?
Yeah, so the IRS has actually sent 3 different versions of action letters at varying levels of, I guess, seriousness maybe is the correct answer. The general tenor of the letters is indicating that the IRS is aware or believes that the taxpayer has had some transactions in cryptocurrency but either failed to report them, they don't know for sure if they report them, they think they did but maybe not correctly, depending on the taxpayer's specific situation. And they've also started sending mismatch notices to taxpayers saying the third-party reporting from the exchanges on the 1099-Ks are not matching what is shown up on the taxpayer's return, which actually will almost always be the case. The 1099-K reporting is a gross proceeds reporting and would not take into account the taxpayer's basis in that. So in most cases, those transactions will not match. As of thus far, they have not expanded the 1099-B reporting to these exchanges. That would require the exchanges to track the taxpayer's basis and report their net gain or loss as opposed to the gross proceeds. But to date, I have not heard that that is even on anyone's radar to do that. So taxpayers receiving those mismatch notices, unfortunately, typically it isn't necessarily an indication that it's wrong, but there is a response required to the IRS indicating what the basis was and why what was actually reported on the return was correct as opposed to the gross proceed number that the IRS is looking at.
Yeah, and to further that, I think these 10,000 action letters that got sent out are going to be really important. And I think that if you have any clients that have received them, you have to treat them very carefully. When you think about the history of cryptocurrency, again, prior to 2017, it was the Wild West. I mean, nobody really knew what to do with these things. Some people were taking the position that they were like kind exchanges. Some people were taking the position that nothing was reportable. So I think when the IRS goes through these responses, I do believe that there are going to be some examples that are going to become public examples, because I think the IRS tends to want to show their point of view to the public in terms of potential, perceived intentional manipulation of facts or conclusions. So, this action, along with potentially new guidance that may come out in the near term, I think is definitely going to be it's going to signal a new chapter in the history of cryptocurrency in terms of how the IRS looks at it, and really send a signal to the marketplace on how seriously to take it.
There's also been a lot of work going on behind the scenes at the IRS in terms of training their employees and their examiners on cryptocurrency. They released a, I believe it was over 150-page slide deck / Word document that had been developed for an internal IRS training. They walked through the history of cryptocurrency, the different types of cryptocurrency, the tax consequences, where taxpayers were potentially not reporting it, how to identify situations of non-reporting, but then it also delves slightly into the fact that unfortunately cryptocurrency is a common means of compensation in areas of white-collar crime or even drug trafficking, and so how to identify and use the cryptocurrency information to try to track those activities as well. So there is a lot going on in the IRS on this right now, and don't be surprised if the examiners who do show up actually do know what they're talking about. I know that is not always the case, and especially with a lot of these new cutting edge issues, it isn't always the case, but don't be surprised if they actually do understand the issues.
Yeah.
Okay. And David, how about the HMRC?
Okay, well, certainly from the UK perspective, having issued a large lump of guidance in December 18, HMRC receive a lot of information from other bodies like banks and building societies for people's interest, the land registry for land transactions, and they would sort of gather the information based on people's national insurance numbers or tax numbers. So having now got that information from major sources, they're now starting to write to the cryptocurrency exchanges to try and gather further information, which will give them a clue about who they should be writing to. So we're probably just at the early stages at the moment, but I should imagine that a few people will start receiving letters saying, please tell us about this. We would like to know more, particularly as it doesn't appear in your tax return.
I would like to say thank you to our 3 panelists, David Cairns, Andrea Mouw, and DeMayo. If you could please complete the questionnaire about the evaluation if it comes out, and also you can reach HLB through our website or through text sending an email to tax@hlb.global. Our next webinar in this series will be on September 24th, and that webinar will be discussing the issue of permanent establishment. Again, thank you for your attention and your participation. Goodbye.